Okay, let's answer some questions from Sunday's market outlook. I also asked the question, what sub-industry would we be doing next? I'm narrating the ocean shipping videos now. Should be done by tonight. They should be up on the site tomorrow. So it's a matter of where do we go next? So we'll read off some suggestions as we get to them. Warehouse retail such as Costco, Walmart, Target, Home Depot. That's a fairly easy thing to figure out. I don't know how interesting that would be. These are box pushers. When I say box pushers, I mean you have a store front and boxes come in the back door and boxes go out the front door. And they come in the back door, they go on shelves, customers come in, pick up the boxes, and they walk out with them. So it's really just judging the effectiveness of it in terms of market share and the efficiency of it in terms of inventory turnover, return on capital, things like that. But it's not a hard business to figure out. We know what Costco does, right? It's not, there isn't any difficulty in figuring it out. Same with Walmart. They have different markets, but they really do depend on the health of the user that's using them. So I don't know that they'd be that interesting. Fast food restaurants, Chipotle, Cava, Qdoba. Yeah, that sounds interesting. More suggestions. Brokers, IBKR, financial clearing and data providers, SIBO. Yeah, industries, footwear, apparel, parcel shipping, downstream energy. That sounds interesting. Downstream energy, luxury goods, nuclear, cybersecurity. Those two, I'd probably be more interested in doing nuclear or cyber than retail, because retail would be short. Really, there's not much to figure out there. But nuclear and cybersecurity, it's complex. So there's something to figure out, right? That's where I can really add value. Cybersecurity, there's another one. You mentioned to gauge Vegas health based on LVS. Las Vegas does not have presence in Las Vegas anymore after the sale of Venetian. They're playing Macau and Singapore. So that shows you how much I still follow the casinos in Vegas. I used to do a lot of that. 2006, 2007, Wynn Resorts, Las Vegas Sands, but I haven't touched casino stocks for a long time. 3 questions for the week. Have you ever created a synthetic position on a stock? Lots of times. Lots of times, especially a dividend-paying stock that is based in another country. Lots of times. What are the advantages and disadvantages of such a move? The only disadvantage is there is some point at which it expires. And at high interest rates, it is expensive to do a synthetic because the options are priced on a forward curve, which increases its steepness based on the interest rate. Low interest rates, the carry is really cheap. Let's take ABR as an example. ABR is a nice dividend yield. So if I create a synthetic position on ABR, I get my dividend in as a capital gain. You get the present value of the continuously compounded dividend yield, not the dividend yield. So if the yield, let's say, is 12%, well, that is, based on what it pays and the price of the stock today, you have to turn that into a continuously compounded rate, and that would be in the put. The continuously compounded rate would be in the put, along with the interest rate. If I create a synthetic position on ABR, I'll get my dividends. Not all of them. The present value of the continuously compounded dividend up to the expiration date. So let's say that you go 9 months and you had a dividend here, a dividend here, and a dividend here. This continuously compounded rate would be in not just counting 2 dividends. It would be the present value of the continuously compounded rate. And since it's continuously compounded, it's kind of like accrued interest in that sense, sort of accrued dividend. If I only sell the put and get it assigned, I'll get a lower buying price. Yes, plus the dividend and the price of the put. Yeah, but I'll have to pay normal dividend withholding taxes. Yes. So if you are in the U.S., the only reason you would do that is to get a preferential treatment on the dividend. However, keep in mind that you get more of a cash dividend holding the stock than what the present value of the continuously compounded dividend would be. Okay. The other thing that you don't see when you're holding the stock, let's say you're holding $20,000 in a stock, and there are, I think, almost exclusively investors simply do not account for this, whereas the options do. That's why the options, I think, are a purer form of return than what the stock is. You're holding 20,000 of ABR. Let's say it's 13, it goes to 15. And over the year, you're going to get $1.72 in dividends. So you've got $3.72, and you think, well, I've made $3.72 off of my investment. However many shares you have. But cash rates for 1 year are about 5%. So you are foregoing $1,000 to do this. So right away, you have to make $1,000 because at the very basic level, we could all be in cash and earn 5%. So if I'm going to do anything, I'm giving up my 5% to go somewhere else. So if I only get a 5% return in a stock, I haven't done very much, have I? So you're giving up the 5%. So there's thinking, well, I had 20, now I have 21,000 after a year by investing in ABR. Yeah, but you could have had 21,000 anyways. You have to account for that. The option accounts for that, E to the R minus Q, right? E to the R minus QT, continuously compounded interest rate, continuously compounded dividend. So the option accounts for it. So the return you get on the option is an excess return because you had the carry in there. Here you don't have any carry. You then have to, after the fact, figure out what your excess return is by subtracting what the risk-free rate was. If more investors did that, they would find that their excess returns are pretty pathetic, right? The option clarifies that for you. The option is your excess return. That's what I like about that. It is tax efficient because it is a capital gain and not dividend. And if you're in another country and you're doing a synthetic, if you're in Canada and you're buying the stock, you have USD exposure. But if you do a synthetic, your USD exposure on your purchase is zero. You have no USD exposure. The only exposure you have is in the gain or the loss that the synthetic provides, but the initial investment has no currency risk. So no currency risk, no US withholding. The dividend is now taxed as a capital gain. As far as a Canadian investor investing in US stocks, if there's liquid options, why would you ever want to take on currency risk and withholding taxes when you could do it with a synthetic? What do you think about the Trump play that seems to be going on? Well, I'm going to take I'll answer that without any judgment on the individual or the policies, and just answer it in terms of the trade. Markets are forward looking. So if there is a risk on the horizon, it will price that risk in. Risk is two-sided, right? If there's an expected return, it could be higher, it could be lower. That's what risk is. Risk is the dispersion around the expected return. The markets will begin to price in risk. Trump looks like the ticket's going to win, and looking more so now, especially after the shooting and the continual gaffes by Biden, that it won't be just a small win, but a big win, which means that he'll be able to get done a lot of what he wants to get done. And he's already said what he wants to get done. Tariffs. He does not like big tech. He certainly doesn't like Facebook because Facebook kicked him off. He doesn't like Twitter, but Twitter has a new owner, and the new owner is paying a lot of money to try to get him on his side. Musk is paying a lot of money, $45 million a month in a PAC till the election. Some 250 million he's going to put in there. His VP does not like EVs. Trump does not like a mandate of EVs. I think he's going to get rid of that and extend ICE for a long time. So all of these things will be priced in. So what do I think about it? I think the market is doing what it does well, which is discounting risk and future information. It's doing a good job of that one. Are you leaning in or not? Yeah, because he wants interest rates to go straight down. And there's been some pushback about, well, he can't seem to get that done. They want to abolish the Federal Reserve. He's going to get interest rates to zero. Okay, he's gonna get interest rates down. You don't know what he has no limits on what he's willing to do. He has no limits on what he'll fire everyone. He has no limits. He's not conventional. So if he says he's going to do it, I believe he's going to do it. He's going to break a lot of shit along the way, but he's going to do it. So yeah, I'm leaning into that. Political one, you don't need to answer if it's too personal. What do you think about the incoming Trump presidency and his recent VP pick, Vance? A couple of things here. Youth, thank God. Thank God. Does this all have to be an 80-year-old club? Thank God. Let's get some youth in there. I see no problem with that. He was a critic of Trump in the beginning. Now he's sort of, anybody who's given a seat of power is going to say anything they need to say to get that seat of power, and he's saying it now. I don't know enough about him to have an opinion about him, but I do know enough about Trump to know that this is the Trump show. Period. This is the Trump show. Everyone else is there for show. Everyone else is there for show. That's it. So he may have some ideas of what he wants to do, but he's got to make them Trump's ideas, and Trump's got to do it. This is the Trump show. He does not share the stage, and he does not share power. Period. So it doesn't matter what you think of him. He's there to get Ohio, and maybe remove some criticism about the 80-year-old club. He's 39. That seems to be intentional to me, but anybody who knows Trump knows this is the Trump show. Period. Industry suggestions: uranium mining. Yeah, that one sounds interesting. Energy production. Yeah, that would complement the energy one I've done on exploration, E&P exploration and production of energy. When you say production, I think you actually mean energy generation. So like utilities, but I've already done utilities as well. I wonder what you mean there. But I get uranium mining. 3 questions on ENB. Could you speak a bit more on the reasoning behind your new position in ENB? I like it due to its mixed portfolio midstream utility, just like all gas. So when I sell puts, I need an underlying to sell puts on. and an underlying should be something at a price I don't mind owning and that generates good income. ENB checks those boxes. Do I think it's a $100 stock masquerading as a $49 stock? No. Where is ENB right now? Let me just move over here. We are sitting at, in US dollars on the NYSE, $36. Do I think it's a $60 stock? No. Do I think it's a $32 stock? No. There you go. That's all I need to know. Is that it's going to hold its ground. It's not going to give up much from here. If I have to hold it, it's got good dividend, good cash flow. If I don't have to hold it, it's got fairly decent, not great, but fairly decent options. I can get a little bit more aggressive with the options rather than 10 delta or 20 delta. I can do 30 or 40 delta options. And it has a higher return on the capital I need when I sell a put than a money market fund. Good enough. That's what I look for, because I have cash I need to deploy and I got to put it somewhere. You don't want to just throw it around. You want to make smart moves. This one here has I think a good solid floor, and you have interest rates coming down in Canada. That's good enough. Utilities are very bond-like in their cash flows. It will price like a bond. I have a beautiful tailwind on this. It's energy, which is great, and I have that upside. Also, for the winter, it looks like we're switching to an El Nino, which will mean colder temperatures in the northern hemisphere. So that can only help natural gas and utilities that service northern climates. So I'm good with ENB. Do you see impressive growth over the next decade in the industry? Growth, I would remove the modifier impressive. I see growth over the next decade. or steady gains. Okay, I see what you're doing there. Yeah, steady gains that are reliable and realistic. I do see that as the base case. It depends on the build out of the assets and the seriousness of the change in the infrastructure. You are getting pushback on both sides of the border as to the speed of this thing happening and how it's financed, with a carbon tax, things like that. Trump is going to be a friend to fossil fuels, so that could slow down the transition. Trudeau is pretty much done here in Canada, as much as he wants to replace the finance minister, because Chrystia Freeland is, well, she's a bridge troll. No one likes her. No one likes her. He thinks he can do better by getting Mark Carney in there. And that might give the Liberals a bit of a shine if you get Mark Carney in there. But I think you bring Mark Carney in, then you have a leadership struggle between Carney and Trudeau. Carney, head of the Liberals, you could get another Liberal victory. And Carney is pro-green. So, he's got good Liberal credentials and would be liked more than Trudeau. He did great for the Bank of Canada when he was there. So who knows? But you get Conservatives in, they're going to be more friendly to Alberta. So it depends on how the assets are built out over the next decade. But if you think that things are going to be more digital in the future, if you think that you're going to have autonomous vehicles, if you're going to have autonomous vehicles, you need a network. If you have a network that's energy intensive, so you're going to need more energy. If you think you're going to have more EVs, you're shifting energy usage from the pump to the home utility, right? So the utility is going to have to expand no matter what. If you think that the AI revolution is just at its beginning stages, and I think it is. I think it's going to go through a period of overbuilding before it crashes, and then you're going to have decades-long building, because I think it's going to make inroads. That's all going to require more and more electrons to travel over copper, so copper and utilities. Yeah, I think longer term, the asset build there will be great. Politics will either shorten this or lengthen this, right? It depends on how you see it, or how you not how you see it. It depends on how the population votes. It seems to me that it has strong growth prospects domestically and abroad due to the abundance and cheapness of natural gas in North America. Plus, North America seems competitively advantaged in energy-intensive businesses. That is true. North America is one of the most energy-efficient countries in terms of energy cost per dollar of GDP, because GDP is energy-intensive. Producing more output requires more energy input. And the U.S. is one of the most efficient in terms of its energy cost per dollar of GDP. Reading many 10Ks history about a company transcripts, I had the experience of adoring a company. I wish to stay objective. Well, that's the thing about 10Ks and 10Qs and investor presentations, is they are all wonderful. They paint the company in the best possible light, even in the worst conditions. You'll read a 10K and they'll tell you about how they're going to fix everything and how their growth is going to be wonderful. So you do have to take it with a grain of salt. 10Ks are written, and 10Qs and investor presentations are written with optimism. Because this is what you want. You want management with optimism. You want management to recognize problems but be optimistic. Because if they were pessimistic, you would think, man, they're running the company and they think it sucks. You don't want that. So you when you read 10Ks, yeah, there is a tendency to say, hey, this is pretty good. These guys are doing pretty good. That's a good idea. This is a good idea. You have to look at not only what they say over time, but their ability to actually execute. So if you're reading, let's say 5 years of 10Ks and they have a plan, And the next year you see, well, they still have the same plan. It didn't really execute. And the next year they tweaked the plan a bit. It didn't really execute. Then it's like, okay, well, what you say is one thing. What you can get done is another thing altogether. So Tesla is a good example of this, right? In 2019, he said that there'd be 1 million robo-taxis on the road by 2020. People believed him. We're 2024. And we were supposed to have an August event, and that's canceled. Now it's an October event, and no one believes there'll be 1 million cars on the road in 2024. But 5 years later, you're still saying the same thing. When you're reading the 10K, you'd say, okay, when it gets to the section of robo-taxis, you'd say, okay, well, look, you have these big visions that you think are going to happen tomorrow, but the reality is it really doesn't happen tomorrow. When you read 10Ks, you got to look out for that. Warehouse, retail, fast food would be interesting. I also think, given how diverse the customer discretionary sector is, maybe something like gambling or travel. Yeah, I haven't done much in consumer discretionary. Maybe it's time for them to have something. You mentioned Trump favors low-rate environment, suggests Powell might lose his job if he doesn't listen to Trump. However, considering the competitive dynamics with China, I believe that Trump's trade policy could be more effective with a rather high interest rate, provided the U.S. economy is robust enough to withstand it. You have with Trump, I really do believe you have to stop thinking about what would be the right thing to do, and you have to start thinking about what is going to be the Trump thing to do. That's it. Trump's not going to listen to that. He's not going to listen to well, if you're going to do this is policy should be in the other place. No, I want low rates, I want tariffs, and I want a weak dollar. And he will just fire people if they don't do it. He's not a thinking person. He's not well read. I'm going to say he's not well educated either. I think most of his education was paid for by donations. I don't think that it'd be interesting to see his transcripts. He doesn't care. He doesn't care about that. He doesn't care about that. He wants what he wants, period. So, you can think about it from an academic perspective or a practical perspective that higher interest rates would help your tariffs be less inflation. He would just yawn and look away, and as soon as you left the room, he'd say, how do we get lower interest rates? How do we get higher tariffs? He's going to break a lot of stuff to do what he wants to do, but he's going to do what he wants to do. I mean, you're going into a quasi form of dictatorship here. A democratic dictatorship. Yeah, there we go. That's what a Trump presidency will be, I think, a democratic dictatorship. Here's what I think. So China's current economy heavily relies on exports, which would be significantly harmed by high tariffs. That would only make Trump happy, because if he'll threaten to do that to get something out of Xi. He'll be willing to back off that, but he wants something. He'll get something. Domestic demand in China is quite weak. He doesn't care. Trump sees weakness, and here's the difference between someone like myself and someone like Trump. Let's say I'm fighting an old man and the old man's down on the ground. It's time to stop. It's time to stop. Trump would keep kicking him. It's not enough to beat him. You have to beat him so badly. It's not enough for Trump to win. You have to lose, and not just lose a little. You have to lose a lot. He can't just win. You must lose. You must lose a lot. Demand is quite weak. Good. That's a perfect setup for him. China must suffer even more. He must show that he's the baddest dictator on the planet, not Xi. He's the baddest dictator, and Xi's got to come to him on bended knee. That's what he's going to look for. And if Xi is willing to bend the knee, yeah, he'll relax on the tariffs. But Xi has got to bend the knee. Period. China needs the Fed to cut rates so the People's Bank of China can follow suit as China aims to keep its currency with a specific range. Trump's tariffs would damage China's export. You're thinking too much. You're thinking way too much. Trump wants lower interest rates. No thinking. Trump is threatening tariffs on China. If Xi shows the proper respect, comes with gifts and bends the knee, Xi will get what he wants, but he has to do that. He has to show that Trump is the baddest dictator, period. Don't think this through. This is not a thinking man. This is a bull in a china shop, and he's going to break things, period. I wouldn't lay out an argument that would sway Trump, where he's a thinking man stroking his chin going, you bring up some good points. No, 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 no. Let me say it one more time. No. What is the 5-year break-even rate useful for? I've always wondered that myself. I mean, I look at these rates and I think, I don't know. They seem, to me, they're a result, not so much a causal factor. So it probably is there, and the 5-year break-even. It's the 5-year rate 5 years from now. And it is just, if you have a 10-year rate and you have a 5-year rate, what would the next 5-year rate have to be indifferent between two series of 5-year rates and a 10-year rate? That's all that is saying. And it is a result of where the 5-year break even is in the 10-year. It helps measure longer term inflation expectations. So you may have 5-year break even. Let's do this. Let's say 5-year break even, and maybe that comes in at 2.4% per year, and the 10-year break even comes in at 2.6% per year, and you think, oh well, that's not so bad. Well, if you calculate the 5-year forward, since this is growing at 2.4% and this is growing at 2.6%, and this will continue to grow at 2.6%, you would need a much higher rate to be indifferent between the two. So it would be 1.024 to the 5 multiplied by 1 plus r to the 5 to equal 1.026 to the 10. So 26 to the 10 divided by 1.024 to the 5. And you would take the fifth root of this, or let's just back that up. You'd say to the power of 1 over 5 minus 1 equals r. Solve for that, and you'll get what the rate here is. So it could be that, okay, for the next 5 years, things are okay. Okay, the 10-year looks okay, but because of the difference between the compounding, there is some significant inflation that is expected in the second 5-year period if those are the rates. I just don't think that the market really looks at it and goes, oh, there's too much there. Data center sub-industry. Prologis, big industrial REIT, reported earnings and has suggested that data in its future is going to be a big driver. I don't align with your thesis on why Tesla's data is worth zero. That's okay. Fully connected cities will still need sensor data from cars. Sure, which Tesla already has. So does everybody. You don't need data to have sensors. A sensor just tells you the state of the item. That's what the sensor tells you, is the state of the item. No one is saying that you're not going to need zero data. It's the data that Tesla has that'll be worth zero. Cars will need to navigate unpredictably in terms of road, pedestrians, getting on, off freeways, merging lanes. Yeah, and the whole grid will be connected. Decisions made by a car in traffic will also be computed. Okay, so here's what I'm saying. Right now, you have a lot of training going on data. So here's a road. Here are some things in the road. And here is a Tesla vehicle. It has to figure out what all these things are based on some probability. It has this big neural net, right? And it comes up with an answer over here, right? This is what this looks like. It starts breaking things down, coming up with a probability. Okay, this is what this is, this is what this is, this is what that is. Well, imagine it starts going, okay, well, what is this thing? And this thing says, whoa, stop. This is what I am. I'll just tell you what I am. I'll just tell you what I am. You don't need your cameras and your software to figure out what I am. I'll tell you what I am. I'll just tell you. Well, then all of this is useless. If I don't have to figure out what everything is on the road, all of that is useless. Do you get what I'm saying? If the road is going to tell me what everything is, I don't need to figure out what everything is. Now, that's not saying that there's nothing to figure out. But what is to figure out will be done in part by all of the sensors that are out there that will just say, here's my state, here's my current state, here's my current state, Well, here's my current state. Here's my current position, my current trajectory, and my current state. So that all you will do is receive the information and go, oh, okay, well, I guess I just got to figure out what I need to do now. So figuring out what's in the environment, all of that data is useless, because all you need to do now is say, okay, now I'm getting perfect information about what the environment is because everyone's telling me what it is. Now I just got to figure out what I want to do. That's all. So no, you're still going to have chips, you're still going to have sensors, but you're not going to have these big algorithms that says, I think that is a small human being over there behind the car. That looks like a small human being. There'll be sensors that'll tell you what things are. So there'll be, imagine everyone has a phone. Everyone has a phone. And phones will be made in default mode, which is pedestrian mode. And you're walking with your phone. Your phone is your sensor. It will communicate with the 5G grid that says, here I am. Here's a phone in pedestrian mode. It must be attached to a pedestrian. Right? I'm not a data scientist in any respect, but it seems to me that if you spend a lot of money developing an algorithm to try to figure out something, and somebody comes along and just tells you, it's like, oh, well, I spent 2 years building this model, and now there's this thing that simply just tells you the answer. It's like, okay, well, all of that is useless. That's the future. Let's see. Your analogy is not a good match. It oversimplifies how someone will come to a conclusion. I'm a price-sensitive customer. That determination itself would be ever-changing. Okay, look, I just made that up off the top of my head in the moment. I didn't sit down with my logical framework and make sure that A equals B equals C in every statement that I was making. I mean, that you're overly criticizing something I just came up with rather quickly as an example. I think most people would have said, okay, I get the example, but come on, man. That determination itself would require changing and require reams of data on customers and their preferences. A customer being price sensitive would depend on what. Again, it was just an example. I mean, I just came up with an example to give you an idea, right? It wasn't a treatise on a logical framework with proofs and everything. It's just off the top of my head. I think you missed the point on that. Liability is also another concern. When pedestrians don't transmit data, or city traffic lights stop transmitting data, and a car makes a mistake. Cars already make mistakes. Who owns the liability in case of accidents? We already have accidents. We already have accidents, and self-driving cars already make mistakes. How many people have self-driving Teslas killed to date? Was it something over 20? How many accidents have self-driving Teslas already had? They're already having them. Countries like U.S. are not ready for fully connected cities. There's a lot of distrust in use of data. Making U.S. have fully connected cities will have longer runway. Tesla does have room to create a world. Well, I don't think it's going to happen tomorrow. I'm saying that if you're looking out into the future and putting cash flows on this thing, at some point you have to say cash flow, 0, 0, 0. Like, this cash flow will go like this. It's not like the data will just continue to go up. It has value right now, and then it will eventually go to 0. I don't think anybody is in their forecast of cash flow is forecasting that. I don't think anybody is forecasting that. Tesla's day is not worth 0. Its future value is worth 0. Its present value may have some value, but its future value is worth 0. The data that they're using to have the car make decisions will largely be worth 0 in areas where you don't need it. Now with 5G, you can really only do cities, but almost all vehicles are self-driving on long stretches of highway or county roads. Is once you get out of the city, the decisions that have to be made are not that difficult. GM Super Cruise, if I'm going down I-75 and you're in a Tesla and I'm in a Super Cruise, we're both reading a book behind the wheel and both of us will get to where we're going. Both of us will get to where we're going because that's an easy problem to solve. Two-digit dividend yield on agency. According to the annual report, we use our investments as collateral for our financing arrangements, certain hedge transactions. As a result, we could be required to sell assets at adverse prices. That's in the risk section. You got to list the risks. I mean, that's a risk. That is true. If you use something as a collateral, you may have to sell at adverse prices. Our ability to maintain and grow our total comprehensive income could be reduced. You'll read that in every mortgage REIT's 10K. In every company that has financial assets that uses those assets as collateral for short-term borrowing will say that. That is just a general risk of borrowing money, period. Over the past decade, the dividend per share has declined from 261 to 144 as of 2024. On top of that, the share issuance also dilutes the dividend per share. Questions are, do you buy and hold on agency just to collect the dividends, or do you have a target price? I think that their target price over the next few years is higher as interest rates come down, and the spread on the MBS to the 10-year decreases. That adds upside potential to the price. Also, as interest rates come down, you have lower financing costs. Plus, it's a great dividend. It's a great return. It's been a great return. Given the possible potential of a dividend cut, dividend dilution on common shares issuance mentioned above, would buying the preferred shares be a better option in the next rate hike cycle? I don't know. It's more of an income play than anything. Now, if you think about it as I get a dividend, I can go out and spend that dividend. I get another dividend, I can go out and spend that dividend. Yeah, that doesn't. At some point, that you've gotten all your money back in dividends. So you buy it, you get a dividend, and you buy more shares. So you buy some initial amount of agency, and you just keep reinvesting that dividend. So even though the dividend per share decreases because you keep reinvesting, the number of shares you have continues to grow. Your return on your original capital continues to increase. You have to see it from that perspective. Sold ABR August 16, 10 puts for 55. That's nice. ABR has had some good strength. Let me just pop over here and have a look at where it is. 1381, up another 10. Three winning days in a row. Monday up, Tuesday up, Wednesday up. 3 days in a row. I think after that weekend, a lot of people had the ability to reflect on it and say, yeah, it's not that ABR is being investigated. It's that mortgage brokers are being investigated at the request, it seems, of the GSEs. ABR has great standing with the GSEs, but there's a couple of accusations from who cares who they are, like idiot short reports. You can't not look at them. At least just to cross them off the list. I think people had the chance to sit back, think about management's performance over the last couple of decades and say, no, I get what's going on. And now they're recovering. 1382. I didn't see any Form 4s yet. Only a statement that they are very confident that things are perfectly fine. They look forward to their second quarter earnings. Ivan Kaufman did sell 17,000 shares or so on July 2nd. Those aren't common shares. If you look at them, they are not common shares. It is an intercompany thing. It is compensation for his role in... So ABR is one company that owns other companies. And these other companies pay for certain things. That if you look at what was sold... it was issued and then sold. It wasn't as if he had them. They were issued and sold. And the amount came to like $250,000. I'm not sure that's quarterly. I think that's annually. So it wasn't common shares that were sold. Airlines next. Would be good if you could do the PPI report for sector studies. I did the PPI. Couldn't really understand the final demand services. Let's trade, transportation, warehousing. I did PPI. I'm pretty sure I did PPI. I did CPI, PCE, I'm pretty sure I did PPI. Sub-industry suggestion, construction and engineering. Yeah, that's a big one. I think there'd be some interesting targets in there who will perform the build-out for utility and telecom. Yeah. How to read conditional versus aggregated probabilities in CME FedWatch tool. I didn't see what they were pointing at for the probabilities. We have the probabilities of rate cuts that are given you in the chart. I'm not sure where you're seeing conditional and aggregated. I would have to look at it again to see what it is they're placing a probability on to know. But a conditional probability would be, what's the probability of A happening if B already happens? Whereas an aggregated probability is, what is the probability of A happening regardless of B, C, or D happens? So, for example, let me see if I can give you an example here. Let's get that off the screen, and I'll just do a simple one. Right, this is A, this is not A. This is B, this is not B. This is B, this is not B. So A could happen, and then B could happen. So the probability, this probability right here is the probability of B given that A has already happened, because we're here now. A has happened, we're here. What's the probability of B happening? This here is the probability of B given that A prime has already happened. And if you add the two together, that is the probability of B. So that's a conditional, that is a total, or an aggregated probability. So what's the probability of B? Regardless of A prime, if A prime or A happen, regardless of what the outcome was here, there'll be some probability of B. B might be more likely here, might be an 80% probability that B happens of A, and it might only be 20% if A prime happens, and you would just multiply these two things out to get this probability. You'd multiply these two out to get this probability, then you'd add these two to get this. So that is the probability of B regardless of what happens. The other two are conditional. That is the standard way of doing it, so that could be what they're doing there. Railroads. Yeah, railroads would be a good complement to ocean shipping, mostly for, well, I shouldn't say mostly for container shipping. You do send coal and iron ore and grains by rail. We do have oil by rail, so yeah, I guess it would complement nicely. What strategy would you use in a closed portfolio where you couldn't contribute funds? So we do have that in Canada. They are called LIRAs. Locked in retirement account. And how you get a LIRA is you work for an organization. Let's build an organization here with a big chimney and a door where people go in, and let's put a big parking lot out here. There you go, there's your organization, and it has a defined benefit pension plan, and then you quit that organization, and you still have maybe 15 years before you retire. Your retirement payment will be based on your last payment here, which will be terrible. It'll be based on your last year of performance here, but you're going to wait 15 years for that. So it's not going to be such a great payoff. You can elect to have the commuted value given to you, but it can't be in a pension plan that you can pull money out of. It has to be locked in. So you open up a LIRA and they deposit it into here. You cannot pull anything out. You cannot put anything into a LIRA. And I have that. What do? You buy stuff. I bought pretty much when I got it, I pretty much loaded up on ABR in that thing. So, I mean, my return on that has been fantastic. From the amount that went in to now, I have massively outperformed what the original defined benefit pension plan would have been, because I was in a high dividend paying winner, and I kept using the dividends to keep buying more stuff. I just kept buying more dividend paying stuff again and again and again and again and again. That's all I did. So you can't contribute more funds. All you have are the funds that are there. It's for your retirement, so you want to be safe. I say high income stuff. that you can then use that dividend to continue to reinvest, because you can't pull it out, so there's no point sitting in cash. In your slide on rates, you mentioned that there is talk about 10-year getting to a 3, but you said there are another 19 basis points to get to that. Yep. Did you mean a 4? No. If you're at 4.18 and you drop 19 basis points, you're at 3.99. There's your 3 handle. Right? If not, the curve would get further inverted, would get further, for the 10-year to hit a 3, that 2-year would drop quite a bit. The 2-year would, if you have the 10-year dropping by 19, the 2-year would probably drop by more than 19, might drop by 25, which means the curve would uninvert by 6 basis points. Do you think the 10-year can get back to 2.5 given all the fiscal deficits? 2.5 is, the word I would describe that is inevitable. It is inevitable. What time frame? I don't know. Sometime before the end of Trump's term, but it is inevitable. It is inevitable. If there are fiscal deficits all across the developed countries, where are we going to get the money for the U.S. 10-year? Well, there are a lot of financial institutions in the U.S. that have to hold U.S. Treasuries. It's a regulation. They have to hold U.S. Treasuries. There is no shortage of demand for U.S. Treasuries. Since banks borrow on short-term, lend on long-term, how come banks remain profitable with negative net interest margin? Who says they have negative net interest margin? Banks don't lend money on the Treasury curve. They lend money on their own curve. So let's say that you have an inverted curve. You have a 3-month at 5.5 and you have, let's just say, a 10-year at 4.2. That's a Treasury curve. If you walk into a bank to get a loan, you're not the government. You don't get to borrow at those rates. You're not the government. The bank can pretty much borrow in the wholesale market at 5.5, 5.4%. But you're not going to get a 10-year loan at 4.2%. You'll be somewhere around 9.2%. You'll be 500, 600, 700 basis points higher. There's your upward sloping curve, right? So the bank engineers its own curve based on the credit risk that you present, but you don't get to borrow at U.S. Treasury rates. So there's no net interest margin. When does the Fed, when the Fed does QE, injects $6 trillion, does the amount of money in circulation actually increase due to fractional reserve banking? Well, when it does it, what it does is it crowds money out of the Treasury market, and it crowds return out of the Treasury market, so that banks would then say, well, there's no point in buying Treasuries, we got to go somewhere else. Individuals say, well, there's no point buying Treasuries, we got to go somewhere else. So you have the banking system and you have the Fed, and the Treasury sells Treasuries. If it sells Treasuries here, what it does is it pulls money out of the banking system and it goes to the Treasury. So the money in the banking system gets smaller. If the Fed buys it instead, that money stays in the banking system because it doesn't go to the Treasury. So the amount of money stays the same in the banking system. You leave that money there. It now has to find another place to go. So it in essence increases the amount of money in the banking system. If you have the applied level under financials, there is a 3-part video series on the Fed. One is on repos. The other one is on reserves. And the last one is on the Fed balance sheet, where I discuss exactly how QE and QT increases or decreases the amount of money in the banking system. What does a negative term premium imply? Well, it implies, if you have a negative term premium, it would imply that something is safer for a longer period of time than a shorter period of time. This can happen in a recessionary scenario where you have curves that look like this for OAS, for high yield. That there is some concern in the short term, especially for debt that's due in the short term. How are you going to pay that with the economy so bad? But if you can survive that, if your debt isn't due for 10 years, things will be okay in 10 years. that the spread would be lower in 10 years than it would be today. So the OAS would have a negative term premium. Powell, in his testimony in the Senate, said that ZIRP era is over. I bet he believes that, and we will never be back to zero rates again. Yeah, well, brave words. What's your opinion on that, since you believe we will turn to ZIRP inevitably? I think he believes that from where he's standing. I think he believes that. But to say, oh, we're returning to the zero line, he could never say that. He could never say that. So he has to say this, that this is over. And I think that there is a belief on his part that it's over. Cateris paribus, everything remaining the same. But everything is not going to remain the same. You're going to have a president coming in who just doesn't believe that and doesn't want that to be true. You're going to have continually mounting and mounting and mounting debt, because no government is going to stop with the deficits. None of them are going to stop with it. So that'll continue on. You're going to have more and more money extracted out of the U.S. economy just to pay the interest on the debt, which will slow down the economy, which means you're going to need lower rates to get that done. Lower rates will mean less money being extracted out of the economy and more stimulus for an economy that's under pressure with all that debt. There is no end game here. If you can show me how the debt game ends, how that resolves itself, then I can agree that you're not going back to the zero line. But until you can show me that the debt doesn't keep doing this every year we go forward, every 100 days, 1 trillion. Another 100 days, 1 trillion. Another 100 days, 1 trillion. Show me the end of that, and then I'll start thinking, well, maybe we don't have to go to the zero line. But with that, you're going to the zero line. You're going to the zero line, because the U.S. GDP is not growing by 1 trillion every 100 days. That's a problem. Your debt is growing faster than your GDP is growing. That's a problem. Any logic in looking at the money market auction results to try to estimate the timing of rate cuts priced in by the market using hypothetical forwards? Why use hypothetical forwards? Why not use actual forwards? Why not just look at the forward curve of SOFR? SOFR is the 3-month secured rate secured by treasuries. And SOFR looks like this. This is a futures curve, not a yield curve. There's the 3-month SOFR's rate for each month. So if we were looking at a yield curve, where this is your money market rates, your capital market curve is inverted right now, this is saying that the 3-month rate should be heading down over these months, so that we do have the path of the short rate that the market thinks, which is the futures curve of 3-month SOFR. So we don't need a hypothetical, we have an actual. Software, cybersecurity. Do you have a price target for COPEX? Not really. No price target. I just don't see a copper shortage yet. So no timeline, no. Commercial mortgages is sub-industry, especially given all the recent news and your expertise, long-term following ABR. Well, ABR is bridge loans, not commercial mortgages. It's a bridge loan. It's not really called a mortgage. There would be a lot of overlap with REITs and MREITs. Mortgage REITs pretty much hold close to residential MBS. They might have some commercial MBS, but when we're looking at commercial mortgages, I think you're looking at probably regional banks and bonds, certain particular bonds, commercial mortgage-backed securities, which is more of a security. Regarding insider buying ABR, isn't there a lockout period? 15 days. Yeah, from my understanding, they cannot buy. I think today is the last day before the 15 days. You sometimes track moves of other central banks around the world market outlook, and most of them either hold or lower rates now. What do you think of Russian central bank projected? I don't even follow Russia because it's non-tradable. What Russia does with their interest rate is they are, if we think about it from an integrated perspective, they are more segmented, a more segmented economy, which means what they do does not affect the outer world. in terms of their monetary policy. Just like North Korea, if North Korea says we're raising interest rate, yeah, so what? I mean, so what? Because of the degree of segmentation now, I think it matters if you're in Russia, but I don't think it matters if you're outside Russia. Followed your applied series since 1 year already, and I would love to see you analyze data centers. Yeah, that's a good one. It doesn't take long to analyze it. I mean, it is most, like, you can analyze it from a REIT perspective. But companies that have a data center, let's say Microsoft owns its own data centers, that's going to be hard to analyze because it's buried within a company that you're not going to get a lot of granularity off of. So you're probably stuck with REITs as a barometer of data centers. Is something like Digital Realty would be a good one. Not that it's a good company. I'm not saying Digital Realty is good, but it's big. And that's all it does. So that would be a good one to look at. But beyond that, beyond the REIT, the power of the REIT structure for data centers, it would be a little bit more challenging. Why annualized rates need to be de-annualized when valuing derivative contracts? What? No, they don't need to be de-annualized. All rates everywhere are stated annually, always are stated annually. So if you have, let's say, 3-month rate of 5.5%, that's not 5.5% in 3 months. That's 5.5% for 3 months. So that would be 1.055 to the power of 1 over 4. You're not de-annualizing the rate. You're just compounding the rate only over 3 months. So you have to compound it over 3 months. Now, there is compounding and there is simple interest. So sometimes you might see 1 plus 0.055 divided by 4. You might see something like that where it's just divided by 4. That is simple interest. Typically, you use simple interest if your interest rate is continuously compounded. But from the move from LIBOR, which was a continuously compounded rate, to the move to SOFR, which is not a continuously compounded rate, you would use the power term to do 3 months, 1 over 4, as opposed to divided by 4. However, a lot of systems have been developed around LIBOR using simple interest. So the New York Fed did put out a thought paper on this, or an opinion piece on this, of whether you should use simple interest or compounding when using SOFR. And the result was, if your systems are simple interest, go ahead and use it. It's not a big deal. It's not that different. However, you really should be compounding the 1-day rate over a 30-day period or 90-day period. So it depends on the system that was built. Being that it was built around LIBOR and LIBOR was quoted continuously compounded, it was always simple interest. But being that we are now in the realm of SOFR and LIBOR is dead, this is the more correct way. Do you read research reports on stocks from firms like CFRA or Morningstar? No, not really. No. Is agency at a point where you would consider selling covered calls? No, not with rates going down. I would not. And rates are coming down. Every day that goes by, we get closer to the rate cut. So no, I would not. Will the new positions be a separate video and applied series? Yes, they will. Part of the market outlook. Nope. They'll be a separate video in the applied series. I typically watch the ammo on YouTube rather than on the site, just because when I load YouTube, I just see the video on the home screen. If it's out or not. I know your longer term plan is to move people away from YouTube to your site. Any chance you can create some sort of notification on uploads? Yes, that will. I am working towards that, but it's not my site right now. So the most I can use is Instagram and X. Every time I post a new video on the site, I put out a notice. But I am working towards something. Just when you say longer term plans, they are my longer term plans, not something that's going to happen in the next couple of months. But starting September, when you see the video pop up on YouTube, the market outlook on YouTube, that means that at that same time, the new positions would be on my site. Chances are I'd probably, I know what my new positions are before Sunday. I don't need Sunday to figure that out. I need Saturday to do my screens and to reflect on the market and to think about what would be important for the week coming up. But for new positions, I pretty much know them by Friday. So that it doesn't necessarily have to be Sunday. So you can pretty much be assured that when it shows up on YouTube, it will be on the site. The new positions will be on the site. Speaker from the Fed presenting my undergrad finance class next week. Frequent criticism I've heard is that the Fed makes decisions with lagging backward-looking data. Plan to ask a question about how the change in data collection may impact the Fed's decision-making in the future, using things like real-time rent data. Yeah, that's good. Do you have any questions for suggestions for improving my question, or perhaps ideas for a different question? Well, first of all, wasted questions are anything about monetary policy. You're not going to get any answer about anything that they may be thinking of doing. You're going to get no answer on that at all. So those are just wasted questions. So wiser questions are, centered around how do they develop their market projections in terms of the data that they would use. And I think your question is a good one, being that you are using a lot of lagging data, and it is lagging data, and it's lagging data, and monetary policy works with a lag. Would you not want to use more real-time data, understanding that if you made a decision today, it's not going to implement for another 6-7 months? I shouldn't say implement, but have the effect you're thinking it's going to have for another 6 or 7 months. Wouldn't you switch to that? I think that's a good question. What do you think in following insider trading for going long short in a stock option? I don't know that there's much value in that, because insiders usually have a selling plan over a number of years, where every quarter they sell a certain number of shares that they own, and that's just part of the plan. Bill Gates did that for years. He wasn't selling on any insider information. It was a plan that was in place and executed over a number of years. So there wouldn't have been any information in that at all. What do you think of Obama? I don't really have any strong thoughts either way. So that's good. Obamacare. Well, I'm not American. I've never had to engage with the U.S. healthcare system, so I can't have an opinion. I can have an opinion on the Canadian healthcare system, and it sucks, because as taxpayers, there are many who don't even have access to the free healthcare. It's free if you can get it. That's the deal. If you can get it, it's free. So it sucks. But I don't know about access in the U.S. or cost in the U.S. Take on U.S. Congress and Senate trading. I don't think they should. There are ETFs that track this. Is this a good idea? Where to get this data? I don't know. I don't know where you get the data. I know that they make their trades public, but I don't even think they should be allowed to. Really, I don't think they should. Do you ever trade options on triple Q? Not really. Not really. I'm thinking of using allocation factory if it corrects 5% or more. Any thoughts? Keep in mind that the incoming administration, and I say incoming, it's pretty much Trump's to lose at this point. The incoming administration is not a friend of big tech. Remember, they kicked him off the platforms, right? He is vindictive. If he's anything, he's vindictive. He won't forget that. And if he can destroy Facebook and Google, he will. He will. And he won't. He'll think nothing of it. The fallout of it, he'll think nothing of it. Nothing of it. He is vindictive. So if you've seen Facebook lately, they've been selling off every single day. If you're a shareholder in Facebook, this guy is going to win, and this guy does not like you. You pissed him off. And you're competing with his platform, right? You're competing with Truth Social. So you're a target. you're a target. I mean, he'll throw the Department of Justice at you. He'll throw antitrust at you. He'll throw FTC at you. No. Why would you want to be there? What's coming up for Facebook is not going to be pleasant. He should do like Musk does and bend the knee right now and start donating to a super PAC, $50-60 billion a month, $1 million a month, if not more. But he needs to bend the knee. Zuckerberg needs to bend the knee fast, and say really nice things about him for the next few months. But if he gets caught donating to a Democrat or a Democrat super PAC, if he comes out in support of Biden or in support of the Democrats, Facebook is under attack. In Applied series, there are good content on options, but I feel like it's light on how to trade futures ES, MES. Just one or two videos, I think. Are there more I may be missing? You don't need more than that. If you're buying a call on ES, keep in mind ES is a futures contract. The only difference is a futures contract and not a stock. You're buying a call on it. All you need to understand is that the forward curve doesn't look like this. It looks like this. That's all. So that the last day of trading here is the first day of trading here, that for September 20th, for example, you'll have a futures contract with an underlying of the September contract and another one with the underlying of the December contract. They will be based around two different prices. That's all that you have to know. After that, everything in the option series applies. Exactly the same way. You can do spreads, you can do risk reversals, you can sell puts, sell calls, buy puts, buy calls, straddle, strangles. Everything applies. Just be aware that it's based on a flat 3-month curve and not an upward sloping curve. Everything is based around one price for those 3 months. If you get that, if you get the difference in the structure of how that works, everything else is exactly the same. I would not have to show you how to do a straddle or a strangle or a risk reversal or a bull spread or a bear spread. I wouldn't have to show you how to do any of those things because I already did, using a stock as an underlying. Now you're just using a futures as an underlying, but you need a couple of videos to say, hang on, no, be careful of a few things. So you're not missing anything. It's just, I think you're thinking that it is so very different from a stock, but it's not. Just imagine that ES is a ticker for a stock, and be careful about which futures contract you're doing because of the date. If you're saying, well, I'm going to make a bet for September, and you sell a put on the September 20th contract, pay attention. Does it have the September contract as the underlying or the December? Other than that, you're good. Thoughts on the judge? The judge. Whatever in creation exists without my knowledge exists without my consent. Is this a biblical thing? Then my thought would be, if it brings you meaning in your life, all the power to you. All the power to you. I wouldn't take that away. When I say that I'm an atheist, the first part of that. So if you're a theist, you believe in God. I am an atheist. I am not an anti-theist. An anti-theist doesn't want you to believe in God, doesn't want anybody to believe in God. That's a very left-wing attitude to have. I'm more centrist on this. I choose not to believe, but I got no problem with other people who believe. I won't force you to not believe. Don't force me to believe. Now, I don't know if that's what this comment means, but whatever in creation exists without my knowledge exists without my consent sounds like something a God would say. Right? So is the judge God? I don't know. The bulk of my options activity, similar to you, is selling puts at strikes below the market that I would be comfortable owning the underlying. That's how you win. For this specific strategy, is there an easy way in IBKR to see what your margin is without calculating it? Yeah, if you go to your options chain, let me just try something really quick. As you're clicking on your options chain, or not your options, but as you're adding the options to whatever strategy you want, you're selling a put. Look at the word. Look for a word profile in that panel. So it looks like this, right? You enter. You'll have your bid and your ask across here, and then you have a number of boxes that fill in some data, like whether it's a limit order, the price, and then over here you have sort of a bar that says profile. Click on profile, and the payoff profile shows up along with your margin. Okay. Curious for your opinion here. If tipping culture went away in US and Canada due to restaurants now paying their waitstaff higher wages, do you feel that the cost would be fully passed on to the consumer? Well, yeah. Yeah, of course it was, but the tip is borne by the consumer anyways. The tip is borne by the consumer, so, so even though it's not mandatory to tip 18% on a meal anymore, your meal is going to be 18% more expensive anyways, pretty much. Pretty much. But no tip. Now you don't have to tip. However, this is what happens, is the tip is in the bill, but you feel so bad about not tipping, you'll still leave another tip anyways, which just means that, they get more anyways. There should be a firm, if the tip is in the bill, there should be a firm no tipping policy in the restaurant, that if you attempt to leave a tip, it's rejected. Sorry, it's already in the bill. It's already there. Thank you very much. But there should be a firm no tipping policy. 18%. And the thing is, I don't agree with the 18 because now the tip was a motivation for good service. That's what it was for. It was a motivation for good service. But over the years, it turned into an absolute requirement, regardless of the service. It was a requirement that you would pay. So you were basically walking in, and the tip was now wage subsidy for the owner of the restaurant. That you were going to subsidize the wages of the staff, regardless of the quality of the food or the quality of the service you got. So it has shifted to being a motivating factor, to being a requirement. Try not tipping. See what happens. Even no matter how crappy your service or your meal is, try not tipping. Thanks for valuable insights. Wondering, what is your opinion on the prolonged rally for equipment rental companies like URI and CAT? CAT. Do you see this as part of a longer trend or just good performance over the last couple quarters? Well, equipment rental is very dependent on growth, especially growth in construction, growth in mining, oil and gas extraction, exploration, anything like that. The rental company is built on that. So I don't know that I would point to that saying there's something here, as much as saying that is sort of a signal that you have something robust somewhere. That if you see that dip, that could mean that economic activity somewhere else is dipping. Passenger airlines. TMSC is on the 18th. ASML is on the 17th. I don't know. Puts on DHI now? No, I would not recommend selling puts on DHI now. You have the idea that interest rates are going to be cut, and off it goes, off to the races. But that's because the belief is if interest rates are cut, the fundamentals will begin to show up. But interest rates have not been cut yet, so fundamentals cannot show up yet. So it can get a little bit ahead of itself, and I don't know if guidance is going to incorporate that in just yet. Please ask Cerify to improve the app user interface. Don't have that kind of relationship with them. It's difficult to find videos since they're all listed in random order. It is better for you to do it than for me to do it. Because you're the customer. Your voice is louder than mine. Hands down. Always. Always. So it is better for you to ask for that. Cybersecurity. To purchase the all-included option with an applied level before end of month, do I just purchase the applied level bundle, apply my CFA level and pass evidence to satisfy the grandfathered option? Yes, you do. Why is UK stock? Oh, UK stock. Clarksons. They are ship brokers. They make money regardless of where shipping rates are. I'm just drawing out the possible path of shipping rates there. Clarkson is a broker, so it makes money either way. Its multiple is 15, 14, 15 forward, which is pretty good considering, you look at SPY, they're pushing 22. Any idea what's going on with NextEra? Well, they are a utility. They're going to be interest rate sensitive. They're going to price out like a bond prices out. So let's have a look at where NextEra is right now. 71.54, down 37 cents. Let's have a look where TLT is. TLT is negative. That is a correlation that's fairly tight. If rates are up, interest rate sensitive sectors tend to be down. NextEra is an interest rate sensitive stock. It would be down. It's just interest rate. The big part of their variability or their volatility moves in interest rates. If you looked at NextEra's volatility and controlled for moves in interest rates, it would be a lower volatile stock, as most utilities are. And there you would probably attribute most of their volatility to what is the subsidiary that they hold that does all the as you get older, you get a brain that does that. It will withhold a word that you use a lot. It'll withhold it and hold it hostage just to publicly embarrass you. But it's one of its subsidiaries. Reading a BNN Bloomberg article, they were arguing the assassination attempt would strengthen the so-called Trump trade. It did. And one of the elements mentioned was a curve steepener. A curve steepener driven in large part by the expectation of the short end of the curve dropping, in part due to his policy spurring growth. I'm curious as to why that part would be part of the Trump trade, considering he's been vocal about interest rates being too high. Yeah, the curve steepener, whenever you have a very high short rates and you get a curve steepener, it's usually because short rates are expected to come down. So that's what you will get the curve steepener, not by the 10-year going up above the 2-year, but by the 2-year dropping below the 10-year. The 2-year rate will start to price in rate cuts, and the 2-year rate will drop below the 10-year, thereby making the 2 to the 10 positively sloped. So just to draw it out for you, just so you can see what it looks like. Let's get rid of this. We have very high rates, and you have a curve that looks like that. There's your 2, there's your 10. So what you would get is the 2 dropping. So the curve would start to look like this, as the 2 would drop to go below the 10. And since this inversion, that's a negative, let's say negative 40 basis points, you might get to 2 basis points positive, maybe 5 basis points positive. Well, that curve steepened. It curve steepened because the 2-year started pricing in significant rate cuts. Because it is, if you think about the 2-year, right, 6 months, 1 year, 1.5 months, 2 years, you've got 4 different cash flows in here. Each one will be discounted by its own spot rate, right? Well, this spot rate here is in 6 months, might have 2 rate cuts in there. This one here is in a year, might have another 1 to 2 rate cuts. This one over here might have another 2 rate cuts in here. So that would then make the present value, it would give a yield that would suggest that there are rate cuts happening over the next couple of years. Are utilities affected by the Trump trade? To the extent that utilities are tied to interest rates, yes, they are. Sub-industry suggestion. Not sure that it's defined as a sub-industry per se, but maybe you could do an overview of business development companies. Yeah. I tend to think of them as banks with a REIT structure. Kind of, yeah. Yeah, they'd be in financials, I think. Yeah. Is there any stock outside Oxy you've analyzed a potential takeover target? No, not really. I've been following Rivian. Feel like although it has challenges, one of the bigger players may come and acquire it. in general, what should one be looking to pick such stocks outside reading what's available on the web? In that space, I don't have an opinion about it. I don't even know what Rivian's market cap is, or if it's even deemed desirable based on the level of their production, or if they have something that nobody else has. I don't know. Yeah. How do you think the deflationary effect of AI and the inflationary effect of a possible Trump's victory would counterbalance each other? Deflationary effects of AI are, at this point, still hypothetical, right? I say technology is deflationary. Technology as a group is deflationary. AI is part of that technology. There is nothing today pointing to it being deflationary. If anything, it just simply increases the amount of costs a company has to incur. If you're spending $100 a month and now you're spending $110 a month, that does not mean that inflation is 10%. That $10 could be for something new that you never spent on before. Well, that is something new companies have never spent on before. So that's not inflationary. It is costly. It increases costs, but you can't say that that is inflation driven. Will it reduce costs somewhere else? That is the promise. That is the promise of it, but that's yet to be seen if it will do that on a significant enough basis to actually be deflationary. And we say that we have an inflationary effect of Trump's victory, but that's, again, if President Xi shows up in Washington and he bends the knee and he offers a bunch of gifts and he tells the world what a great man Trump is, how smart he is, how good looking he is, he's so tall, he's so wonderful. Yeah, Trump will ignore most of those threats, but Xi has to give him something, and the something that Xi has to give is an acknowledgement from Xi that Trump is the bigger, badder dictator, and he's terrified of him, and he's the smart. That's all you have to do. Stroke his ego. Stroke his ego, and you'll avoid it. So, yeah, he wants to put tariffs on, but it's a matter of, the response from China. Now, if China wants to get into a fight, yeah, Trump will break a whole bunch of things just to prove his point. And not prove his point, but break a whole bunch of things such that his point is the only one left standing, thereby proving his point, that he was right all along, because he just destroyed so much to make sure he was right all along. This is how you have to analyze that guy. He's not a thinking man. Don't play chess. Don't even play checkers. Just listen to what he has to say and say, okay, well, how much is he going to break first before it gets done? And it can be avoided if the other person just drops to the knee and praises him to the moon. A lot can be avoided. Musk is already doing that. J.D. Vance does not like EV. Musk is already giving $45 million a month to a super PAC to elect Trump. Already stroking that guy's ego. All right? Because he doesn't want to be a Zuckerberg. Not on this one. Huge run up in SPY. What would your recommendations be for someone starting a passive allocation? Well, it depends on your time frame. Like if you got 30 years, a long-term trajectory of SPY is like that. So we may be here, well above its long-term trajectory, and it may drop. And you may say, I've lost money, but this is where your eye is, right? It'll do this kind of thing over time, and there'll be some things like this. What you want to avoid at this point in time is this. Right, so as it gets closer to this point in time, you must be more concerned about the level of overvaluation, because you can't live with this, because you don't have the time for it to get back to where you want it to be. So as you get closer and closer to your time frame, overvaluation matters more and more to you. If you're 25, who cares? If you have a contribution plan that you plan to contribute to the market over time, who cares? Who cares? Looks like T-bills and bond market now trending together. Good traders in the 80s often talked about confirming moves in the bond market. Frequently mentioned this phenomena by trending together. I mean, they're both below some key moving average. For example, the 3-month and the 10-year are trading under the 50-week simple moving. We discussed this in the live feed on Sunday night. And this is a lot of calculation to come up with a simple, I think a rather simple conclusion. So I would direct you to the live feed. I think I talked about this for several minutes. If Trump wins the election, as being widely rumored, he'll explore policy similar to Plaza Accord to reduce the trade deficit. And besides increasing allocation to international equities, any other creative ideas on how to play this? So, there's a lot of, you see, again, Trump is not a thinking man. So he says he wants to reduce the trade deficit. You have to believe he's going to do it. That does not necessarily mean that's a good thing for the U.S. So, for example, let's say that I do 5 things in my household. I do 5 things. And one of these things takes a lot of time for me to do. That if I didn't have to do that one thing, I could do 6 things. Meaning that this thing takes a long time, but there are 2 other things that I can get done that have higher value. So I have somebody else do this. Now I'm doing 6 things. So instead of my income growing like this, my income can now grow like this because I'm doing 6 things. And this one thing reduces it to here. Do you get what I'm saying? Let me do that again so you see what I'm doing. When I'm doing these 5 things over here, I may have an income trajectory that looks like this. The growth in my income over time. If I can do these 6 things, in other words, get rid of this 4th thing, get rid of one thing, not the 4th, get rid of one thing to bring it down to 4, and then add the other 2, my income could look like this, right? But my income would be my income minus my expenses. For the level of a country, there's your GDP minus your exports. Minus your imports, because if I'm outsourcing this, I'm importing the work, right? So by sending that out, I have to pay for that. So that means I could look like that in the future instead of looking like this by doing it myself. Somebody would point out, but you have a trade deficit. You've had a trade deficit for years. And my answer is yes, because the time and resources it would take to do that thing means that I cannot do these other things because I don't have enough resources. But these other things are worth more to me than this thing I'm giving up. So when we look at the trade deficit of the U.S., we have to say, are these things we really want to dedicate resources to away from higher productive uses because we don't have unlimited resources? Do we really want to do this? Do we really want to bring all of this stuff back onto American shores, which already has a labor problem? And if you want to limit the amount of immigration, you're going to have a huge labor problem, and you're going to have to take resources away from more higher productive tasks. So before you start saying I want to fix the trade deficit, you have to look at each thing line by line and say, do we really want to do this shit? I mean, do we really want to do this? Because we're going to have to take resources away from something and do this. And then the next line item, do we really want to do this too? Right? And eventually you may find that the market is being very efficient and that the trade deficit is such that it allows you to be more productive than you would otherwise, even after paying for it. Besides increasing allocation in international equities, any other creative ideas how to play this? Well, it isn't necessarily going to be a good thing. It isn't necessarily going to be a bad thing. It'll be something that he'll want to do because that's what he wants to do, unless somebody bends the knee and tells him how smart he is, and that person doing it doesn't want it done. Then he'll side with them. So all the things that he's saying now are not necessarily going to happen. Yeah. 2 questions. What are the rules about the use of your name of social networks like LinkedIn? Use of my name? Well, you can't use it unless it is your name too. I'm not the only Mark Meldrum in the world. To complement the CFA Level 1, I spent around 10 months to learn details of your course, applied options, portfolio construct. Can I add this to my education? Yeah, you can. You absolutely can. You can say applied level, even though there was no exam or anything like that. You have gone through it. Sure. I am moving towards some kind of badge or certification for that, but that does require some kind of assessment. How one must properly react to the short report on ABR this Friday. I don't recall a short report on Friday. I sold put only because the source of the report was Viceroy. Well, yeah, that's garbage stuff. What is the right approach to breaking price moving news? There is no real answer I can give you for that. It's a complex web of knowledge about the company, the ability to critically think about what somebody else says, and intuition and instinct, which is something that's developed over time. You can't teach instinct, you can't teach intuition. It's just something that that you develop in time. So I don't know that I have an answer to that. What's the possible explanation for higher PPI when CPI is lower? The answer was margins, because you did have PPI lower throughout the value chain, but you didn't have the final demand was not taking the opportunity to lower prices. They didn't raise prices, but they didn't lower prices, so they increased their margins, thereby making it look like PPI was stronger there. Can one of my kids or grandkids inherit an applied series subscription after me, considering I bought applied series before July 31st? That's assuming I'm going to live longer than you, right? And live to the point where your grandkids get it. There is no expiration on it, but there is an expiration on me. At some point I die, and then I won't be able to contribute to that series anymore. Now, I think that's years in the future, but at some point I die. So it's not hundreds of years of access. It is, when I say it's for life, it's my lifetime. Once I die, that's it. Unless I can bring in new people and new voices over time that can continue to take it on from there, we'll see. What do you think about pharmacy sector in the U.S. with the latest report from FTC denouncing, FTC, screw the FTC. So first of all, that person's gone. As soon as Trump wins, that person's gone. They are gone. And in the video for the applied level for understanding the pharmaceutical supply chain, I did talk about the PBMs. They do play an important role, and I think a good role. Most of the large insurers own their own PBMs, specifically to get lower prices. So if you watch that video, you see I talk about the roles of the PBMs and what the PBMs do. Saying causing drug prices to increase. I don't think so. If you want to find the cause of the increase in drug prices, it's the pharmaceutical manufacturers that do it, that understand the nature of the discounts that they have to give, and they price new drugs at a point high enough that after the discount, that's the price they want. So it is the creeping and creeping and creeping. We need this discount, this discount, this discount to be into this program or this program, that when a new drug comes out, it's priced to the point where it anticipates what the discount's going to be. And if you regress everybody in the value chain, you'll find the biggest significant coefficient is going to be on the drug manufacturer, not the PBM. If the PPI is being driven by margin increase for wholesalers and retailers, they're right to expect improvements in performance for listed retail players. It would be consistent. It would be consistent, but that's just margin, right? That would speak to your gross margin. After gross margin is just sales minus cost of goods sold, right? And then you have all your expenses below that. So if you have those expenses rising faster than your gross margin is increasing, not so much. But as far as gross margins go, it would be consistent with that, sure. Why does the market either rally or sell off rapidly in the last 15 minutes of every day? 2 reasons. Actually 3. Companies that buy back their own stock must stop at 3:30 p.m. So in the last half hour, you don't have that buying pressure. Let's get up to 4 o'clock here. You don't have that buying pressure. There are a lot of index funds that will do a market on close order, so that they buy in the closing auction. So that usually a couple of minutes before 4 o'clock, if you're watching the news feed for a particular stock, you will either get a buy or a sell imbalance report. Well, there's a buy imbalance of so much or a sell imbalance of so much, meaning that there's more pressure on one side or another. Index funds don't want any price risk, so they'll buy at the market close. They usually sell on the market open if they're selling, so that they get the price. Whether it be on open or on close, I don't think it really matters too much, but they try to buy right on the close. Another important point is once you get to about 3:45 p.m., this last little bit right here, depending on how the market went that day, if the market was down, you might see rallies. If the market is up, you might see sell-offs. If you see this kind of thing, if you see a market selling into the close, there's probably some index fund work going on that overwhelms this effect. And if you see it hit the highs into the close, there's probably index fund, the amount of dollars in index funds overwhelming this. These are your day traders. These are your day traders that have to be flat by 4 o'clock. So if they had built up long positions, they got to sell them and get flat by 4. If they built up short positions, they got to cover them and get flat by 4. So day traders sometimes use external services that offer them leverage, 10 times leverage during the day only, but they must be flat overnight. So usually around 3:45, if you're on one of these platforms, you'll get a notice that you've got to get flat, that you can't carry positions into the night using any of their leverage, only your own. So if it was a strong day and you've levered up for the day, you got to unlever. So there are a number of things that go on in that last half hour. Not only that, you may have a fund that was either acquiring or disposing of stock over a period of time. Maybe it was over the course of the day and they were using a time-weighted average price or a volume-weighted average price over the course of the day. Then in the last half hour, maybe there wasn't enough volume that day, or maybe they didn't sell everything they needed or buy everything they need. They got to get it done. So you pretty much got to get the work done by the end of the day. You got to say, okay, well, we've gone as far as we can. We got to get this done now. So there's a lot of things that can happen in that last half hour. But it is not uncommon for volatility to increase in the last half hour and in the last 15 minutes. Sub-industry coal. Are we near the end? Oh, we're all near the end. Okay. Let's see. I have a more general question. What portion of time do you allocate to activities not related to investing? Well, let's take out sleep. Let's say 16 hours a day. Probably half the time is not, I wouldn't even say that. Out of 16 hours, maybe 6 hours, 7 hours is not dedicated. And when I say dedicated, I can't help but think about it. Now, am I dedicating time to it when I'm thinking about it? Right? Or do you mean when I'm just with my face in the screen and my thoughts 100% on it? Do you mean just that? That's not very long during the day, 4 hours, 5 hours, but I think about it a lot. So, if you think about the amount of calories my brain burns thinking about it, I'd probably say 70% of the calories my brain burns is thinking about it. I know you like philosophy, Pink Floyd, Led Zeppelin. Do you struggle to learn, enjoy it all? No, I don't struggle. No. Curious about many things, but have to manage my priorities. Well, that's it. You just manage priorities, right? But no, not really. Recently purchased Applied Level Series, Level 2, Canada, very limited market experience. Can you please guide me how to prioritize and approach these materials to maximize my learning and understanding? I get that question a lot. There is no order for them. Jump in anywhere. Doesn't really matter. It is. I wouldn't think of it as a roadway. I'd think of it as I've just dumped you in the middle of New York City, and there's something to see in every direction you go in. Right? So just start walking in one direction. If you say, but what about that other stuff? Don't worry, you're walking around the city. You'll see it. But there's stuff to see in every direction. It's not linear. It's more like a city street. So just walk around. I hear you selling puts. Why not buying calls? I sell puts on stocks that I want to own that I don't think are going any lower. And I do that because it is a very efficient use of capital. So if I have 50,000, let's say $50,000, and I have a list of 20 stocks that I don't mind selling puts on any given month, there'll be about 4 or 5 of them that are ready to sell puts. The others, not really. The return on this $50,000 by doing this is significantly higher than if I took a stock and I just bought a call and waited for it to go up. It is significantly higher because I have turnover, right? If I buy this call, wait for it to go up, when do I take profit? But these puts, every 30 days, every 30 to 45 days, it unleashes my capital for me to do it to the next one, and the next one, and the next one, and the next one. So I can be more fully invested here with better return on the invested capital than in buying calls. If I believe something is going up, I'll sell an in-the-money put, ITM. So if we have a stock, let me see if I can get rid of this stuff here. And I'll show you what I mean by an in-the-money put, because I've done this quite a few times. You have a stock doing this, and I think, well, I think it's going up. I can buy a call, but then it has to go up to a certain price before I make money. Instead, I'll sell the put, let's say 2 months out, I'll sell the put in the money. So I'll get the intrinsic value plus I'll get some time value. Now, as the price rises, well, I would do better by selling the put than buying the call. The only time the call works out is if it goes much past that price. But even if it only goes up to this level, I've still made all of this plus the time value. And then I can roll forward another 2 months and roll higher up on where I think the price is going. So I can always do better by selling a rolling series of in-the-money puts than by buying any one call. Nuclear energy, downstream energy. Yeah, I think it's either going to be nuclear or cybersecurity. I just have to start looking at each one, and one of them will be more exciting to me than the other. And that's it for today.